Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at D-Wave Quantum.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into the heavy lifting today, I've just got a quick note for you guys. If you're looking for a cleaner way to read your charts, we've actually partnered with VIP Algos.
Yeah, it's a really solid tool.
It is. It's a TradingView indicator suite that's basically designed to streamline your technical analysis. It gives you these visual buy and sell alerts, helps identify trend direction, and maps out support and resistance levels.
Which is, super helpful for your take profit and stop loss planning.
Exactly. You can find our affiliate link down below in the description. Now, as a mandatory reminder here, VIP Algos is an educational tool only. It is not financial advice, it does not place trades for you, and it certainly doesn't guarantee profits.
Right. Trading always involves risk, so please use the tools responsibly.
Well said. So with that covered, let's jump straight into what is arguably the most aggressive market repricing we've seen all week. D-Wave Quantum just experienced this massive 35% surge in their share price.
35%, that is a huge move for a single week.
It's massive.
Yeah.
And the catalyst here is entirely structural. We are looking at official confirmation that the United States government is taking a direct equity stake in the company via the QBTS Act.
Oh, wow. Direct equity, not just a grant.
Right, an actual equity stake.
Right.
And when you pair that with a new executive order signed by President Trump, which legally mandate that the federal government have to migrate all systems to post-quantum cryptography by 2030 and 2031, we're basically looking at the forced creation of a multi-billion-dollar domestic market.
Okay, I mean, the sheer velocity of that 35% move is definitely what caught my attention initially. But I really want to push back on this underlying narrative before we just go ahead and crown them the victor of the quantum race.
Fair enough. What's the concern?
Well, the market has an incredibly short memory when it comes to government-funded tech cycles, right? We've seen these massive policy-driven hype waves before. A federal mandate comes in, it temporarily inflates the valuations, but the underlying companies still lack the commercial scalability to justify those multiples.
You're talking about the gap between government hype and actual business viability.
Exactly. Like, are we actually witnessing a fundamental inflection point in commercial computing architecture here? Or is this just a sovereign-funded sugar rush creating, a localized bubble in the IT sector?
That is literally the exact question institutional capital is trying to price in right now. To figure that out, you really have to look at the structural pivot happening inside D-Wave. They are aggressively attempting to cross that chasm from being just this academic research darling to a highly scalable enterprise solution.
But does the government backing actually fix their commercial scalability issues?
It certainly changes the landscape. The government mandate isn't just about handing out research grants anymore. It's about establishing a domestic supply chain for post-quantum infrastructure before international rivals corner the market.
All right, let's move into the wealth building context. Because if we strip away the geopolitics for a second and just look at this purely from a portfolio construction standpoint, placing a capital allocation into D-Wave requires a very specific thesis.
Right, because this isn't your standard blue chip tech play.
Exactly. This is a pure play entry into the quantum sector. It operates completely differently than, say, gaining quantum exposure by buying Microsoft or Google.
Yeah, with those legacy giants, their quantum R&D is heavily insulated by their massive cloud and software revenues. If their quantum division burns cash, Azure or Search just covers the bill.
Exactly. But D-Wave, it is a high beta, highly speculative growth profile. When you take a position in a pure play like this, you are absorbing the unmitigated volatility of the underlying technology's adoption curve.
Which means this is definitely not a defensive holding you just tuck away for a quarterly dividend yield. It's a multi-year capitalization on a secular macroeconomic tailwind.
Right. I actually look at the current setup similarly to the capital deployment we saw in the early 1990s with the telecom infrastructure build-out.
Oh, the fiber optic boom. That's an interesting comparison.
Yeah, because the secular tailwind back then was undeniably massive, right?
Yep.
Global connectivity was inevitable. But the actual path to profitability was incredibly capital intensive. Investors who bought into the fiber optic rollout had to endure years of brutal cash burn.
Right, because they were waiting for the application layer, the actual software and services that monetize that infrastructure to mature.
Exactly. Taking a position in D-Wave today demands that exact same level of conviction and patience. You are betting on the foundational layer of the next computing paradigm.
And, surviving a multi-year infrastructure thesis requires an ironclad balance sheet to absorb all that cash burn, alongside a business model that actually shows accelerating commercial traction.
That gives us the bigger picture. Now let's look at the fundamentals. Because when you open up their Q1 2026 earnings report, there is a glaring 81% drop in top-line revenue.
Yeah, that's a number that definitely makes you pause.
I mean, they printed $2.86 million for the quarter. In any traditional software as a service model, an 81% year-over-year revenue contraction would trigger an immediate institutional sell-off.
Which is exactly why understanding their revenue recognition mechanics is so critical here. That 81% drop is essentially a localized optical illusion.
An optical illusion?
How so? It's a direct byproduct of their current enterprise sales cycle, which is highly lumpy. In the prior year quarter, D-Wave finalized a massive $12.6 million singular sale of an annealing system.
Ah, okay. So one massive hardware sale skewed the baseline.
Exactly. When a hardware sale of that magnitude hits the ledger in a single quarter, it creates a formidable comparative baseline for the next year. The current quarter's drop doesn't signify a collapse in demand. It just reflects the fact that multi-million-dollar quantum hardware deployments don't neatly align with quarterly reporting calendars.
Okay, I hear that. But we can't completely excuse the top-line contraction just because of lumpy hardware cycles, right? If the actual commercial momentum is there, it needs to show up somewhere in the financials.
That's a fair point.
Because they just took a $32.8 million adjusted EBITDA loss and an $18.4 million net loss. The cash burn is aggressive, and they need to demonstrate that the pipeline is actually filling up behind that hardware anomaly.
And the pipeline is exactly where the fundamental thesis finds its footing. Their bookings surged by an incredible 1,994% to $33.4 million.
Wait, almost 2,000%?
Yeah.
That is a massive jump.
It is. And simultaneously, their remaining performance obligations, the RPO climbed 563%, sitting at $42.4 million. We are seeing immense commercial acceleration. It simply remains locked in the backlog awaiting deployment and formal revenue recognition.
The RPO expansion is definitely the metric to watch there. It proves enterprise clients are actually signing the contracts and committing the capital. But fulfilling a $42 million backlog while running a $30 million quarterly EBITDA deficit puts immense pressure on their liquidity.
Oh, absolutely.
So how solid is the runway here?
Well, they have fortified their balance sheet precisely for this scaling phase. They are currently sitting on $588.4 million in cash and marketable securities.
Wow, okay. That's a huge war chest.
The 93% increase year over year. They've built that substantial war chest to ensure they can weather the operational losses while they transition those massive bookings into recognized cash flow.
Having the capital to survive is one thing, but having the intellectual property to defend their market share against the hyperscalers is another entirely. IBM and Google have effectively unlimited R&D budgets.
True, you can't outspend Google.
Right. And D-Wave's defense against that is their dual platform architecture, which I actually find strategically fascinating. Instead of being pigeonholed into a single technological pathway, they are actively developing both a 100,000 qubit annealing system and a 10,000 qubit gate model system.
It is a brilliant hedge, honestly. They aren't forcing the market to choose between near-term utility and long-term capability.
Exactly. The annealing architecture is highly practical today. It utilizes quantum tunneling to find the lowest energy state for complex multivariable optimization problems.
Right. Things like routing global supply chains, financial portfolio optimization, or, complex manufacturing scheduling.
Yeah, it delivers tangible enterprise ROI right now, while the gate model system is essentially the holy grail of universal quantum computing.
Because it uses logic gates to manipulate superposed qubits.
Exactly. Which is the architecture required for running complex algorithms like Shor's algorithm, the exact mathematical process that threatens classical cryptography, which is what triggered the government's post-quantum mandate in the first place.
And D-Wave recently solidified their position in that gate model race through the $550 million acquisition of Quantum Circuits. They didn't just acquire talent. They acquired a vast portfolio of intellectual property.
Which significantly widens their competitive moat against those legacy tech giants we mentioned.
Exactly. They now control the IP for both the immediate optimization market and the future cryptographic market.
That gives us the business picture. Now let's move to the catalyst timeline, because the market isn't going to wait 3 years to see if the dual platform strategy works. They're going to trade the stock based on the immediate calendar.
Right. Investors want to see the near-term triggers.
Exactly. The most pressing friction point is their upcoming Q2 2026 earnings print. Institutional investors are going to dissect that report to see what percentage of that $33.4 million booking surge has successfully transitioned into recognized revenue.
They essentially need to prove their deployment cycle is actually accelerating, not just stalling in the backlog.
Yeah. And beyond their earnings print, the finalization of the $100 million QBTS Act equity contract is the dominant macro catalyst.
Because the U.S. government shifting from just being a passive grantor of research funds to an active equity stakeholder structurally alters the risk profile of the whole company.
It clearly signals that domestic quantum capability is now a Tier 1 national security priority, driven by the broader technology competition with China.
Yeah, the geopolitical tailwind is undeniable there.
It is, but there is a highly speculative, unpriced catalyst floating around the periphery of the stock that honestly makes me nervous.
Oh, the White House mandate rumors.
Yes, the QBTS mandate. There's heavy market speculation regarding a directive to build a fully operational quantum system by 2028. The rumors strongly suggest D-Wave could be selected to house the system at a Department of Energy facility.
Right. The DOE rumors have been everywhere lately.
My concern is that retail capital is already pricing in a contract that hasn't even been awarded yet. Are we baking in unpriced, speculative government contracts?
Look, the logic behind the rumor definitely makes sense structurally. The Department of Energy requires hybrid compute capabilities. They need annealing for immediate grid optimization and materials science, and they need the gate model for complex simulations.
And D-Wave's dual platform makes them the leading candidate to fulfill both natively.
Exactly. However, I agree with you. Treating unconcerned federal procurement rumors as a guaranteed revenue stream is an incredibly dangerous way to manage risk. The confirmed QBTS Act equity is a bankable catalyst. The Department of Energy facility remains purely speculative upside until ink actually hits paper.
Catalysts tell us what could change the story. Now let's pivot to the chart. Following that massive 35% upside expansion, the price structure is currently in a holding pattern, recently closing at $25.03.
Catching its breath, basically.
Right, and when we look at the momentum profile, the RSI, the Relative Strength Index, is currently flatlining at exactly 51. So is an RSI of 51 a healthy pause for consolidation, or is it a sign of exhaustion after the government news hype?
I'd say it's highly indicative of a market absorbing a massive catalyst and waiting for secondary confirmation. An RSI of 51 sitting right after a major breakout signifies a decidedly neutral market state. We aren't seeing severe profit-taking or rapid distribution.
So the buyers are holding firm.
Yeah, the institutional buyers who stepped in during the surge aren't dumping their shares.
Yeah.
They're consolidating their positions and establishing a new support base right around that $25 level.
The volume footprint during that move definitely confirms the institutional presence. We saw 46.5 million shares exchange hands, which is a full 36% above the 3-month average volume.
That's a massive liquidity event.
You don't generate that kind of liquidity from retail traders just chasing headlines on their phones. Those are block trades, dark pool prints, and heavy institutional reweighting. We are seeing major whale alerts flashing across the entire IT sector, specifically targeting this ticker.
And when you have volume that significantly deviates from the mean like that, it validates the price action.
Yeah.
The smart money is clearly repositioning their portfolios to capture the post-quantum cryptography migration, and they are utilizing D-Wave's liquidity to gain that specific exposure.
So the chart gives us price structure, but what does market sentiment look like? The institutional accumulation we are seeing on the tape seems heavily supported by the sell-side analysts.
Well, the analyst live is very real right now. Currently, D-Wave holds 13 active buy ratings with 0 sells across the board.
0 sells. That's rare after a 35% rip.
Yeah, and the consensus price target sits at $36.84, representing a massive premium to the current trading range. Firms like Mizuho and Roth Capital have actually been aggressively raising their targets in the wake of these government mandates.
The analyst community is clearly repricing the stock based on the U.S. Department of Commerce acting as a cosigner on the company's future. When a sovereign entity takes an equity position, it drastically lowers the perceived cost of capital and essentially places a floor under the company's valuation.
It does. But the sentiment isn't just institutional. The retail side of the market is becoming incredibly aggressive too.
Oh, because of the political trackers?
Exactly. The Nancy Pelosi stock tracker, which monitors congressional trading activity, flagged this 35% surge. And that alone acts as a massive lightning rod for retail inflows. Retail traders just love to copy trade political sentiment.
Which leads to the inevitable question of market saturation. When you have top-tier Wall Street analysts, institutional block buyers, congressional tracking algorithms, and retail momentum traders all aggressively crowding into the exact same side of the trade, you have to wonder who is left to provide the marginal buying pressure required to push the price higher.
It's a valid worry.
Right. When high-profile trackers and whales are all piling into the same narrative, is the trade getting too crowded? When a trade gets this saturated, the vulnerability to a downside shock increases exponentially.
That sentiment picture is useful, but we still need to talk about the risks. Because beneath the bullish sentiment and the government mandates, the financial reality of D-Wave's current scaling strategy presents severe headwinds for common shareholders.
The primary headwind being significant dilution risk, I assume?
Exactly. The Washington windfall is not free capital. That $100 million CHEVS Act injection resulted in the direct issuance of equity to the Department of Commerce.
Right. And when you combine that with the massive stock issuance required to fund the $550 million acquisition of quantum circuits, you are dramatically expanding the outstanding float.
And every time you expand the float, you suppress the earnings power of the existing shares. The enterprise valuation of the company might be growing, but the market capitalization is being spread across a much wider base of shares.
The drag on future EPS is just a mathematical certainty at that point.
It is. The market is currently forgiving the dilution because the capital is being deployed to secure monopolistic IP and cement a government partnership. But if the commercial execution falters, the expanded float will severely punish the share price.
If they keep issuing shares to fund growth and acquisitions, does the average retail investor's slice of the pie get diluted down to nothing?
Look, the dilution is painful in the short term, but you have to remember that this dilution effectively sets a government-backed price floor and secures their scale, their buying market dominance.
Which brings us directly to the execution risk. We've established that their revenue model is currently reliant on lumpy, infrequent, multi-million-dollar hardware deployments.
Yeah, those massive one-off system sales.
If macroeconomic conditions tighten, or if a major enterprise client delays a deployment by just 1 or 2 quarters, D-Wave's top-line revenue could miss consensus estimates by a wide margin.
They are absolutely in a race against time to transition their revenue model away from those lumpy hardware sales and toward a predictable, recurring software model. Specifically, quantum computing as a service.
Choosy AS.
Exactly. Until they can prove that their $33 million booking backlog is translating into high-margin, recurring QCA as revenue, the stock will remain highly susceptible to intense volatility around every single earnings release.
So with everything on the table, what's the final verdict? We have an undeniable macro tailwind driven by federal post-quantum cryptographic mandates. We have a pure-play quantum architecture that effectively hedges its bets with a dual-platform approach.
And we have a 1,994% expansion in the booking backlog.
Right. Conversely, we have an aggressive cash burn, a highly volatile revenue recognition cycle, and significant share dilution capping the near-term upside.
Taking all of those variables into account, the bullish score comes in at an 8 out of 10. The target horizon for this capital allocation is strictly a multi-year hold.
Yeah, this is definitely not an asset you trade for a short-term swing.
Not at all. The transition from massive infrastructure deployment to recurring software monetization takes years to fully scale. However, in terms of a summary, it is a buy now for investors wanting to capture the secular shift toward post-quantum cryptography.
The main upside driver being the U.S. government literally taking an equity stake.
Exactly. While the main downside risk is that continued dilution. But just to be absolutely clear, we are not telling anyone to buy, sell, or hold. This is strictly not financial advice.
You must conduct your own due diligence and assess your personal risk tolerance before entering a position of this volatility. And for those of you looking to manage that volatility and bring more clarity to your own chart work while you research, make sure to check out VIP Algos.
It's such a helpful tool for charting.
It really is. Their indicator suite provides excellent visual mapping for trend direction and structural support, which is vital when navigating a stock experiencing this level of institutional repositioning. The affiliate link is right down below in the description. Just remember, it is an educational tool only. It's not financial advice. It doesn't guarantee results, and trading inherently involves risk.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.